Imagine a world where the more money you owe, the more opportunities appear. But the moment you try to stand on your own, the system quietly pushes you out. A world where debt opens doors and independence shuts them. It feels wrong, almost upside down, but this strange design was built intentionally. We've been taught that debt is dangerous, yet the modern system rewards anyone who borrows and punishes anyone who tries to live without it. How did we reach this point? Who shaped a structure where dependence is profitable and independence is a threat? 2. Answer that. We must travel back to the origins of the financial world we live in today. Centuries ago, money meant something physical. Gold, silver, land, resources. Your independence determined your power. People who controlled their own wealth couldn't easily be influenced. That was a problem for those who desired control. Slowly, a new idea began spreading among early bankers and monarchs in Europe. If you control debt, you control people. This concept reshaped nations, fueled wars, collapsed empires, and laid the foundation for the global banking model. Debt wasn't created to help people. It was created to make them manageable. And the deeper people sink into it, the more predictable they become. To understand the trap we live in today, we follow the timeline of how debt transformed from a tool into the engine of the world. In the early 18th century, European governments were constantly fighting wars and constantly running out of money. Kings couldn't fund armies or expand their empires without borrowing, so they turned to private banking families, Rothschilds, Medici, Barings, and others. These bankers had gold, networks, and influence. But lending to rulers was risky. If the king lost, the bankers lost everything. So the bankers proposed a new arrangement. We lend you money if you let us create your money. This agreement created the first central banking systems. Money was no longer tied to a physical resource. Instead, it was issued as government debt. Every unit of currency became an IOU. From that moment on, the world entered the era of debt-based money, a system where money itself is created by borrowing. By the 20th century, the global economy depended completely on borrowing. Governments borrowed to fund wars and infrastructure. Corporations borrowed to expand. Citizens borrowed to live. Mortgages, business loans, student loans, credit cards, government bonds. The entire structure rested on one principle. More debt equals more growth. Countries with high debt were seen as powerful and trustworthy. Countries with low debt were labeled weak or underdeveloped. Debt became the measure of strength. Independence became a barrier to economic growth. Instead of the old world, where owning resources made you strong, the new world rewarded those who owed money, because debt kept the machine running. The moment everything changed, the system locked into its modern form in 1971, during the Nixon shock. Until then, global currencies were still linked to gold, which created natural limits. Governments could not simply print endless money. But when the gold standard ended, money became completely unlimited. It could be created with a keystroke, backed only by government promises. When unlimited money meets interest, debt exploded. This governments borrowed more than ever. Corporations expanded through borrowing. People relied on credit to survive rising costs. The world finally became what early bankers envisioned. Money equals debt, and debt equals profit. How it punishes independence into a system. Anyone trying to live independently finds themselves punished. If you save money, inflation reduces its value. If you avoid loans, you have no credit score. If you buy a house in cash, you're flagged as unusual. If you work without a bank account, you can't rent or travel. If you run a business without credit, investors don't trust you. Independence breaks the machine, so the machine rejects it. Meanwhile, dependence is rewarded. Take loans, you get better opportunities. Use credit, your score increases. Borrow more, you gain more access. The message is simple. Depend on the system, and the system will empower you. Stand alone, and it will limit you. This is not accidental. It is structural. Over the last 50 years, governments attempted to escape the debt spiral through austerity spending cuts, interest rate hikes, tax increases, currency reforms, IMF programs. None worked, because the system cannot function without growing debt. If borrowing slows, economies collapse. If governments stop issuing bonds, their currencies fail. If people stop taking loans, banks break down. You cannot repair a machine designed to repeat the same cycle. Look at the global situation now. Global debt exceeds $307 trillion, the U.S. adds. $1 million in debt every 40 seconds. 74% of Americans live paycheck to paycheck. 1 in 3 millennials may never own a home. Real wages haven't grown in decades. Workers carry more debt than any time in history, yet banks report record profits. Markets hit all-time highs. Governments continue borrowing. The same loop continues. Debt rises. Crisis hits. Bailout arrives. Debt rises. This isn't a cycle. It's a self-reinforcing loop, designed to continue until something breaks. 1. Debt is the system's core product. The economy survives only if borrowing continues. 2. Independence weakens the structure. Saving, self-reliance, and financial discipline threaten the machine. 3. The system resets. It never stabilizes. Inflation, recessions, and bailouts are intentional mechanisms. We may be approaching a point where the system cannot reset quietly anymore. When the next major break occurs, the real question won't be, will the system survive? But who will survive inside it? If this made you think differently about modern money, share it. And if you want more breakdowns of global debt, central banking, and the hidden loops controlling our financial lives, subscribe.